All right, guys. This is being recorded, and something I mentioned at the beginning of every single webinar, you guys, is watch this again. The reason why I say that is because, the way I build this strategy may be very well different than what you read online and stuff like that. And there's also a lot of nuances that go into this strategy that might blow by you the first time. The second time through, I think you'll catch on to it and you'll remember it a little bit longer. But that's why it's important to really watch this once again. All right. So please remember. Oh, wait, let me get on with this. I got a little ahead of myself. A couple of things get out of the way. My name's Eric Wilkinson. You might recognize me from mainstream media as the Wolfman, where I've talked about everything from economic to geopolitical and market analysis. Started trading in college, and in that time, from then till now, trading my own money, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products and just about all market conditions. Please remember, past performance of any trading system or methodology is not necessarily indicative of future results. And please keep in mind that when I'm talking about some strategy or this strategy and talking about specific stocks later on, that I'm not trying to get you guys limbing off the cliff with what I think the overall markets are doing. I'm here to teach you guys how to implement these strategies in your portfolio in your own way. So what I'm talking about might be counterintuitive to what you're doing, and I don't want to get you all caught up in that either. So keep that in mind. Follow us on Facebook at ProTraderStrategies.com. I don't have that on here, but our Twitter handle is at ProTraderStrat. My personal one is at Wolfman's blog. So you can follow us there where get all kinds of market wisdom and snark from me probably. All right. I saw there was a lot of new faces on this webinar, so I wanted to get options 101 basics out of the way because we are going to be dealing with a lot of this going on in our portfolio. So with this strategy, delta affects the option premium in relation to the underlying first dollar move. So think about this. When we're building this strategy out, we're actually going to be doing an in-the-money option. So we're going to be starting out at about an 84 delta. So if the underlying moves up by $1, our strategy for that long call is only going to increase by 84 cents for that dollar. Okay, so think about delta affecting our premiums for that first dollar move. So if it's like a 0.84, that first dollar move, it is going to increase by only 84 cents on that side. So we have to keep that in mind. But delta is going to start increasing as it goes along because we have gamma. And remember, gamma goes with delta. That's the easiest way to think about gamma. Delta is like the linchpin of all of this stuff, but gamma just goes with delta. And really, it's the rate of change to delta, but it really affects delta on the second dollar move, all right? So on dollar move number one, remember, this is the dollar number one, and then on dollar number two, gamma affects our premiums after that. So let me pull up a platform real quick, and then we'll get this over here. I was looking at my McDonald's trade, if you guys have been keeping track with the daily market commentaries. All right, so let's just keep up McDonald's right here. So, so McDonald's, we have the delta, the gamma, the theta, and the vega, all right? So what we're looking at here is the delta. That's the first dollar move. So these premiums on that first dollar move higher are going to increase by the corresponding delta. So we can look at it. Let me just pull this pen up. So if we're looking at this column right here, on that first dollar move, this goes from $200.79, and now we're thinking about it being $201.79. All right, so we've gone up by $1. What happened there? So we've gone up by $1. So we're at 201.79, 201.79. So we've gone up by $1. All right. So these premiums will then increase by the corresponding delta. So we just draw it all the way across. The 200 calls are going to go from $5, and let's call it right in the middle is $5.30. It's going to go up to now $5, middle of the road would be $5 and what did I say, 85 cents. Okay, so that makes sense, right? So it increased by that corresponding delta. And then we started talking about gamma, and that's on the second dollar move. So we are talking about this being now 202.79, just to keep the math a little bit easier. All right, 202.79. Well, that first dollar move, we went to $5.80. What did I say? 83 cents. So it went from $5 to 83 cents. Now on the second dollar move higher, gamma goes with delta, so it gets added in there. So now that second dollar move, these strikes are going to increase by 56 cents. So we had $5.83 on that first dollar. So that was on dollar number one, on the first dollar, right? That was our premium. Now on dollar number two higher of an increase, let me just throw that on there. On the dollar, we have that extra 56 cents added in. So now we're looking at $6 and what is that? $6.36. Did I do that right? $6.39. $6.39. You're right. $6.39. John David is all over it. He is like the abacus in his head. So that second dollar move, our premiums would then be corresponding to that. All right. And same goes for all of these other deltas as well. You can see deeper in the money, the gamma starts slowing down. The at the monies have a little bit more gamma in them. All right. But with this strategy, it's a poor man's covered call. You can see as you go deeper in the money, that delta starts increasing more and starts catching up with as if we had just done the underlying. And that's ultimately what we're trying to do here, is build this strategy out so it performs just like a covered call strategy in a sense. Actually, it's more of a covered a call strategy with, or sorry, a long stock with a collar around it, because we are going to be able to limit our risk to the downside with this, as opposed to, with a stock, a covered call, you're limited, or your risk isn't limited to the downside, right? You can go all the way to zero and lose that money all the way down. But this is going to basically be like having a synthetic collar around a stock. And the reason why is because if we're buying an in-the-money call on this strategy, which is going to be further out in duration, but if we buy an in-the-money call, we have no risk below that strike that we would buy. All right. So if we're looking at the 84 delta, we wouldn't have any more risk to the downside. So that's the beauty in this strategy as well, as opposed to just a covered call strategy. All right. So that's talking about gamma. All right. So gamma is on that second dollar move, and theta is the thief in the night. Easiest way to remember that: theta is the thief. He comes and steals your money. It's the impact of time on premium. Every day, theta, that thief in the night, comes and steals some of our premium. So when we're looking at that same option montage, anytime I refer to the option montage, it's this page, you guys. It's basically the page that has all the options, and the strikes and all of that stuff is considered the montage. All right, so theta, this thief in the night, he's going to come and steal our premiums. And every night he's going to steal, for the 220 calls, a penny. For the 210 calls, he's stealing 3 cents. Obviously, over here on the put side, theta still steals that premium. Now, you'll notice something I didn't mention before is if we're looking over at the put side, which we aren't going to be talking about really today, delta is negative, right? Well, the reason why it's negative, because it's assumed everything goes up, all right? So when it goes up, these premiums would decrease by that 47 cents. A dollar increase would decrease these premiums. Vice versa, if it goes down a dollar, negative a dollar plus a negative delta means that it becomes positive, right? So it become positive to this. Vice versa, if it goes down by a dollar, all right, then these premiums are going to decrease by the delta, right? So, and then theta is always a thief. You can't go back in time. We're not going to roll back time on this, right? I'm not going to wake up tomorrow and it's New Year's Day again, right? So theta is always a negative to this. Every day, theta starts eating away at your premiums. And you will notice that theta becomes more aggressive the closer we get to expiration. So he starts getting more aggressive. We start looking inside of these days, and you can see that the theta is really starting to pick up. All right. So that is theta. And then we go and look at, yes, I do have those calls are starting to go in the money. But if you guys were watching the daily market commentaries, I own McDonald's from an earnings play where my puts got, I got put the stock at 200. And I actually, since last earnings, lowered my cost basis on this for $4. So I was happy to get out at a scratch there. That's why you lose on your position on Theta Decay if we buy versus if we sell, right? Absolutely. If you buy something out of the money, especially, in the money has Theta Decay as well. But if you buy this premium every day, if the market doesn't move higher, all other things being equal, if McDonald's stayed right here at 200, these calls would all go to zero. Same with these puts. If in 50 days we're right back at 200, that Theta Decay, all of the options that are out of the money have all Theta Decay or all theta, extrinsic value. It's basically, volatility and all of those things added into that, but it's all extrinsic value, means they're out of the monies are worthless if nothing happens, okay? Where in the monies have some value, and that's called intrinsic value. So intrinsic value is what the strike is actually worth. So these 200 calls right here are trading for $5.40, right? Well, what is that 200 call worth? Really, it's only worth 79 cents. So all of that rest of that stuff is actually extrinsic value, or, what theta can eat away at in the next 50 days. My life Theta Decay is definitely accelerating. So is mine. I used to be pretty good, probably about as good as John David on coming up with this math, but Theta Decay is eating away too. Pretty funny. My funny guy's in the house. All right. My funny guy, Rick. All right, Vic. The Vic volatility is Vega, all right? And that's a measure of change in volatility on our premiums, really, is what I should say there. I see a couple of people throwing up some things real quick. I'll get to that in just a second. Let me get on to the Vega. And Vega is right here. You can see the Vega number. It also corresponds with this column. And what this is saying, for every increase in implied volatility here, it goes from 17 to 18. Well, our premiums are going to increase as it goes up from 17 to 18. Our premiums are going to increase by the corresponding Vega. Now, volatility does affect further duration options more than the nearer duration. So keep that in mind. So as volatility upticks across the board, across the option montage, our further duration options will be affected more dramatically than the nearer duration, okay? And again, it goes up by 1 percentage point. These would increase by that corresponding Vega by like 30 cents on these puts, and on these calls by 22 cents on the 210 calls. All right. Doesn't it apply to delta as well on the put side? If the price goes up, the premium will fall. Yes, correct, because delta is negative. And the reason why delta is negative is because it's assumed a positive move in the underlying, really. All right, so a positive dollar move, if we go back to that, affects the premium of the underlying. It's for every dollar move higher, okay? So for every dollar move higher, this premium is going to decrease by that amount. That's why that's negative. But what I was trying to say here is if it goes down by $1, well, that's a negative dollar. A negative plus a negative equals actually a positive, right? So when we think about our math there, and vice versa. A negative dollar plus a positive delta means that that's a negative delta, right? So it would decrease by that. All right. On the put side, so if the price goes up, the premiums will fall. So isn't it better to sell the put and get the negative delta to help? Yes, if you are believing in a bullish assumption, right? Then yes, you would. If you had a bullish assumption, then you sell puts, because as that market goes up, then your premiums goes down, right? Now, there's a lot more that goes into like selling puts and selling calls than just that. I have specific rules as to timing and the environment and stuff like that when you want to do that, or when is optimal to do that. I don't have the time to really go into that, but yes, you are on the right page there. Since you lose theta getting closer to expiration, is it advisable to add an extra month onto your trade to cut down on the loss of the shorter time frame option? Depending on what you're doing, Kevin. Like if you're buying it, then yes, you want to get out in time. And I'm going to get into that a little bit further. You know, you don't want to be inside of 35 days or 45 days to expiration when you're buying, because that's when theta really starts increasing. So you want to get out further when you're buying that and closer when you're selling it. And this is going to be the perfect example of those two. And I'm going to drill into that quite a bit here as we go further too. So isn't it better to sell the put and get the negative delta to help? Yes. If you sell, well, if you're talking about with this strategy, no, because we have a synthetic put added in here. Remember, because I'll talk about how that works here in a second, but I just wanted to get the Greeks out of the way real quick before we start moving on. So like I said, this is the poor man's covered call. And so with this, we obviously need to come up with our directional assumption. And this is actually supposed to have a chart in there, which I don't know why my chart's not showing up here, but basically it has a chart that is looking like that. All right. Trying to be funny. Not working out with that one, I guess. I don't know why that doesn't come through, unless you guys could see it. So basically, looking at that chart, I came up with a bullish assumption. Now we have the bullish strategy, which is the poor man's covered call. Some reasons why we call it the poor man's covered call, or some things I want to get out of the way. It's more of a diagonal spread or covered calls on leaps, all right? It's not a calendar spread. The reason why is because we're not using the same strikes, all right? So it is a diagonal spread. We're using a longer duration. Usually a diagonal spread is 1 month to the very next. Now, you can do that with this strategy and create it that way, where you're just doing 1 month to the next, especially because, you know, right now we're dealing with that February, which has like 50 days to expiration, you know, just a little bit outside of that theta warp zone that we want to get into. But still, it is more of a diagonal spread. We're going to be using it on leaps though. And it's basically a covered strategy on leaps. And because we're buying an in the money option there, we are going to be basically having a synthetic put. Now I'll talk about that, how that works out, but we're going to buy the in the money leap. This is basically where I'm talking about. We're going to be looking, we're going to start at about the 84 delta. All right. That's just a good rule of thumb to start out with. And then we're going to be selling the spot month. And now when I talk about the spot month, that's usually the month that is closest to 35 days to expiration. That's usually where the eyeballs are. That's why it's called the spot month. It's where everybody's got their eyes on and what they're paying attention to. At least most traders are. Most traders aren't watching the leaps on any given day. You know, usually their option Montage is open to the spot month. Now, right now we're in that February month, 50 days to expiration, where the Jan contract is expiring in like 15 days. People aren't watching that 15 days to expiration quite so much. There's a lot of, don't get me wrong, there is a lot of people watching it, more day traders and stuff like that. But the institutional guys, the most volume on any given day is generally speaking going to be in that spot month, which is as close to 35 days to expiration as you can get. Right now, what people are doing is they're rolling from the 15 days to expiration into that 50 days. So for the next 5 days, you're going to be seeing a bunch of roll happening. So you might see some pickup in that volume in the shorter duration, but it's basically because it's a rotation out into the further duration. So the spot month, we're going to be kind of looking at somewhere around the 35 days to expiration, but it's going to be close to about a 20, let's just say a 25 to 30 delta is what we're going to be looking at for the spot month that we're selling, all right? Which is closer. It's the closer duration. So think about this when we were talking about that theta and everything else. Well, we're buying that in the money leap, which is going to have very low theta decay, and we're selling the out of the money spot month, which is all extrinsic value, and in that we are trying to exploit that theta decay. We want that to happen. That's why we're selling it in the close and buying way out there. We're trying to limit theta decay way out and trying to take advantage of that theta decay in the closer duration. What's the rationale of the 84 delta far away? The reason why is because if you get closer to the at the money, you have more extrinsic value. Deeper in the money options have less extrinsic value. So what we're trying to do is really balance out. What I've done is basically figured out that this is the optimal level just by past trading. You get too far in the money, for one, it gets a little bit more expensive. You can have a little bit wider spread, but at the end of the day, the idea is, I don't know why I have this. This should be a call. I'm sorry. Out of the money spot call. So we're selling an out of the money spot call. So that being further out in time is, I got a little bit, 84 delta. You get too far deep in the money. For one, it gets a little bit more expensive. You can make it a little bit wider, but to me, I want this call to really be tested, to be quite honest. I want this spread to go all the way up there and hit it and make that money. Now, if you don't mind, you can go a little bit further in the money, and sometimes I will. The idea is this is where we kind of get our starting point. This is kind of where you're really going to be going out there to that leap, looking at about that 84 call and 84 delta call, seeing how much extrinsic value is, and then find what I ultimately want to do is sell this one to pay for all that extrinsic value. And if you do that, then you'll ultimately be buying the underlying in and around where it's currently trading. And so basically, you're going to set this up like a covered call with, or a long stock with a collar, really. It's better than a covered call strategy because you've got limited risk to the downside. All right, let me get over the max loss, all that stuff. Max profit, though, is the width of the strikes minus the debit paid. We're going to be paying a debit, you guys, because we're buying an in-the-money option, and the out of the money is never going to pay for that unless you consistently roll these short calls out. Max profit may be considered unlimited because of the different expiration cycles. Remember, we've got that short call with a nearer duration. Well, if those short calls never get breached, well, we get to keep that credit, and we could have on these long duration calls for as long as that option, remains available. All right. So that time frame, it could go to infinity. It's probably not, but the idea is if you get out of that short call, then, you have unlimited upside potential. Max loss is the debit paid. Because we're buying an in-the-money option, that 84 delta, well, whatever we pay for this strategy, that's our risk. Because when you are buying an option, you have the right, but not the obligation to exercise the contract, okay? When you sell that option, you have the obligation, all right, to fulfill the contract. But if, it never gets breached or never goes in the money, nobody's ever going to call you out on that. So you don't have to worry about it. That's the beauty in selling option premiums. It's the risk reward in it. Break even is that long call strike plus the debit paid. So when we're buying this in the money option, and I'm talking about trying to pay off all that extrinsic value, that's so that we can get our break even to where the underlying is. Because if our long call plus the debit paid equals where XYZ is trading, then that means we bought this underlying, or we bought this strategy at where the underlying is traded. All right. So let me get over a couple of these things and then we'll get into the platform. Why would we use the options in place of stock? Because we're going to reduce our risk. If we have limited risk to the downside, it's better than doing a covered call strategy in the regular way where you buy the stock and sell a call. We reduce our capital requirements because we're dealing with options. You're allowed to leverage a little bit more. It's not like buying the underlying outright. It's going to be a lot less margin requirement. We're going to be able to create a more diversified portfolio of securities. Why? Because we paid less for this one to equal what the other one's doing. Higher probability of success. Well, because we have limited downside risk and we got that covered call strategy, it's better than just going out and buying a call, say, for instance. Return on capital is better because we have less margin outlay, and therefore, if it does the same thing as what, say, a covered call strategy would do, then our return on capital is much better. Now, remember, when you're doing a covered call strategy, you are lowering your basis a little bit, but at the end of the day, you still have limited upside risk, whereas you do have unlimited downside risk, or at least it going to zero. And when you do that strategy with covered call, you're going to have to pay a lot more for the stock. And then you have the margin on top of it with the covered call. It's going to be a little bit less because you own the stock, but you're still going to have that double ding on you, if you will. But with the options, you're paying much less outlay on the margin and your upside potential is just the same. All right. Problem is with trading this is we are going to have to stay active in earnings, okay? But and what I mean by disadvantages of this, rather than just saying go out and sell a put or something like that because of your bullish strategy, this is more of a long-term bullish play. But, keep in mind that if you bought the stock, you were going to have to be in earnings also, or at least active during earnings. Long calls eventually expire. Those leaps will expire within the next 100 days or something. So we do have to worry about that. Forced assignment. When we're selling calls, somebody could come in and, take our stock away because we're short a call. Well, we don't necessarily have that stock. So what happens? We would have to assign somebody our in the money calls, right? Good problem to have. We still make up our difference. That spread still comes into account, right? Because, if we bought this at, we bought the 220, let's say this underlying is trading 230. Well, we bought the 210 calls, right? And then we sold the 240 calls to cover that. Well, if it's trading 240, we still made up that difference of our spread. So we've still got it. Now, we used to have to worry about the, assignment risk of all the fees that go into it, which got a little expensive. But now they've basically gotten rid of all those, so we don't have a whole lot to worry about there. At the end of the day, once our short calls get breached, I would cover this strategy anyway, because you've made up that difference. You've made your money and you're good to go. That's no reason to stick into it or stay in it any longer. All right. You don't receive the dividend. We're not buying the stock, so we don't get a dividend. That's the downstroke. All right, rules of thumb. Now, you guys watched some of my webinars before. I was talking about the keys to success. Really, the rules of thumb with this are the same thing with the keys to success. Any stock with this one, we need a tight bid ask. So when we're trading options, just because you know of a stock out there, say Aon is a good one. Aon doesn't usually fit the rule of thumb. Everybody's heard of it, but the bid ask on Aon gets really wide. Now, McDonald's is usually very tight, but our rule of thumb on a stock over $100, then we're going to be looking at the option montage closest to 35 days to expiration. That is the February at this point. And any stock that's over $100, we need to move the decimal 3 ticks to the left. So 1, 2, 3. So now we're looking at 20 cents. All right. I'm going to switch my pen. All right. So now we're looking at 20 cents, right? So we're looking at 20 cents there. Maybe it's my hands dragging. Sometimes it does it and sometimes it doesn't. I don't know why it's not consistent. All right. So 20 cents. And we come down here to the bid ask. You guys are going to give me trouble all day. 20 cents. So we look down at the bid ask right here, just out of the money on the 35 days to expiration, closest to 35 days to expiration. And you can see this fits that rule. These are 14 cents. These are, 25 cents. That doesn't really fit, but this is during open market operations as well. You guys make sure you check that after hours. Like right now, a lot of orders are getting canceled, so it doesn't fit that rule. But 20 cents to the bid ask. If it's a $102 stock, you'd move it over 10 cents. It'd have to be 10 cents. Something that's like $138 stock, we'd be looking at 14 cents wide to the bid offer. Now, if it's something under $100, then the rule of thumb is 10 cents wide to the bid ask. All right. So we look at the option montage closest to 35 days to expiration, and we want these to be equal to or less than 10 cents wide. That just shows you, rather than having to go in there and saying, okay, is there a lot of volume and open interest going on? Well, there's a lot of open interest. There's not a ton of volume. The volume's probably more in here right now still. There's a lot of open interest. But like I said, these people are going to be rolling back in time. So we're kind of in that middle influx area where people are rolling. So, but you can look at GDX and see that there's still quite a bit of volume and open interest in there. And that's because there's a lot of eyeballs on here. That's why these markets are even tighter than that other one. It's because people are falling over each other to make better markets. If you have a lot of eyeballs in there and somebody all of a sudden says, all right, well, I'll be a 90-cent bid. Well, then your 89 cents not being represented. So you start moving up and you kind of leapfrog each other and make tighter markets. So the more eyeballs, usually the tighter the markets are. All right. As everybody's trying to get their market represented on the market. All right. So if it's less than tight bid ask, so what we're looking at here is if it's less than $100 stock, if XYZ is less than $100 stock, then we want to be looking at equal to or less than 10 cents wide on the bid ask. All right. And if it's greater than $100 stock, then basically we're moving that decimal, right? We just do the 1, 2, 3 thing, right? Move the decimal, and that's about how wide they should be. That's a pretty good rule, especially on the ones for less than $100 stock. But when you're looking at stocks that are over $100, those markets can get a little wide and be somewhat intimidating when they're 25 cents wide. Well, when they're 25 cents wide and it's a $300 stock, well, that's actually a pretty tight market, to be quite honest. All right. So I see a couple of questions. On the assignment problem, the problem is with the short leg, right? Yes, the assignment problem is with the short leg. But remember, we're going to be making up that we're just creating a spread here, and we're trying to make money on the width of the spread minus that debit we paid. So if our short calls are breached, well, we've made up that width of the spread minus the debit we paid. So we have won. We've beaten the probability. So that's a good problem to have. All right. I can talk about some delta here when we pull up the option montage a little bit later on some of that stuff in probabilities, but we've beaten the probabilities. If our short calls been breached, we've made the width, we've accomplished our goal, and we should get out. I wouldn't write it out. There's no sense in letting it go $5 even higher than that short call. You're probably definitely going to get assigned. And then you got the headache of assigning your other long calls to somebody. All right. Stay away from that. You know, you got to offset the short because they can't pull away from you. You're going to be, you know, your deltas are going to get off. It'll become a little bit more messy. Because remember, if you're short the underlying, right, outright, you are short 100 deltas for every contract you have. All right. So that means for every dollar move higher, you're losing $1 on it. Well, your in the money calls might only be about a 95 delta. All right. So you're going to lose like 5 cents on that. So just as soon as your short calls are breached, close out the position, you'll be happy. All right. So if the UL is the 200 and the long call is the 210 and the short leg is the 220, the price goes to 230, both will be assigned. Well, you actually have to assign, assign them your in the money calls because remember you have the right but not the obligation. If you're short the calls, you have the obligation. And usually when you're short calls, somebody is going to take your stock away from you. All right. Does that make sense? If you're long, you have the right. So it means you have to actually, go through with that. You have to say, I want those stock at this price from somebody. But when you're short the call, you have the obligation. And you probably aren't going to get assigned when it goes 20, 30 cents in the money. You might, or you might have them called away from you. You might, but the likelihood is it's usually when it's a few dollars into the money that you start having to really worry about that. And if you hold it to expiration, you definitely are going to get that stock called away from you. All right. If you write it through expiration, it is most definitely going to happen. The brokerage firms are going to make that happen. All right. Even if somebody doesn't say it. All right. Actually, if you're long those calls at expiration, you're probably getting the assignment happening as well. All right. So rules of thumb, most people, remember we talked about leaps here. So with me, I'm not doing that. I'm going like 6 months to maybe a year out. It's 365 days out. I'm usually looking 90 to about 150 days is usually where I'm looking at for this. All right. But the rules of thumb, some people say those leaps are long-term anticipated securities. All right. So those are, really far out. I don't do that. The reason why is because we talked about that intrinsic value and extrinsic value, right? I want to be able to pay off all of, or at least most of the extrinsic value, that theta component as quickly as I can. So, and I'm not usually riding something out 3 years down the road. I don't know what any stock's going to do that long out. So usually this is for a trending stock, and I'm usually not loving being in a strategy more than 90 to 100 days anyway. So that's kind of the wheelhouse I like to look at. I like to look at shorter duration. If you like to look at the longer duration, that's all good. Just know that when you're selling these calls at like that 25 delta, you're going to have to do that quite often to lower all of that extrinsic value. You got to pay off that extrinsic value as you go. All right. All right. Don't pay a lot of extrinsic value. Have I beaten that into the ground enough at this point? Can you please remove the toolbar on the left? Yes, it goes when I touch on the when I need to pull up my trading platform, and sometimes I forget about it. All right. Oh, the toolbar on the left. This one. Sorry. Yes. My that's so I can draw on my trading platform. I'll get rid of that on the left. All right. Good now. Is that good? When the short call is breached, won't the long call also be breached? The long call is breached immediately. And it won't be necessarily 100 delta, but it'll be a close. So he's saying when the short call is breached, won't the long call also be breached and be at 100 delta? It'll be close to 100 delta. The long call will probably be close, but maybe not. It might be like a 91 or a 93 or something like that. But it's gone from an 84 to like 93 or something. I'll show some of that more as we pull up the trading platform here. So don't pay a lot of extrinsic value. My rule is here, we're kind of looking at what we pay versus the width. So for instance, on this one here, you know, I talked about like the 24 delta and the 84 delta. You couldn't get exactly that. So we bought these, the 92 and a halves at 13.24, and then sold the 110 calls at, you know, for let's say 80 cents. All right. Well, the width is what we need to look at. So we're looking at this being $17.50 wide, and we're paying $13.24. And that gives us we're paying about 75% the width of the strike. That's a green light, or the width of the spread. That's a green light. You know, you can see some of these get up to like 84. I've even seen them as high as like 90+%. You don't want to do it when it's that expensive, all right? It means what's happening is you're paying a lot more out here for volatility than you're getting paid for volatility inside. Remember, we said that volatility affects the further duration. That means you're paying too much for this out here. So 75%, the width of the strikes is what we want to pay. That's what we want to assume. If we're paying about 75% the width of the spread, that means we paid off that extrinsic value. All right. We want lower volatility stocks, right? We don't want to do something with like this Gilead where it's just all over the place on any given day. All right. That is just too much volatility. I want something that's going to be like a slow grinder. All right. I don't necessarily want my short calls to be breached in this strategy. I want a bullish trend. I want to be able to continue to roll these short calls out in time. You know, I might be able to keep into this strategy for 2 or 3 months, right? And then I get to lower my cost basis on this and continuously roll out those short calls. If it happens and my short calls are breached right away in this first month, well, those are rich man problems, right? I made $3 on the trade or something like that, all right? So I'm not going to be angry if it gets breached, but, you know, I would like to keep in this and consistently roll out in time and lower my cost basis, all right? Should we be concerned about historical versus implied volatility? With this, I'm not going to necessarily be too concerned about the implied volatility or the, well, I am going to be concerned about the implied volatility, and I'll get into that here in a minute. But what I mean by this with lower volatility stocks, I just don't want something that's just all over the place. I want something that's more of a slow grinder, maybe utilities, something like MasterCard. It's funny, I've been wanting to get long some of the bank stocks. I might have missed the boat on it, but you know, bank stocks don't really have massive volatility all the time, unless there's maybe an FOMC or something like that, but utilities would be good as well. And we're going to be selling that near term out of the money. We want to get as close to what I'm talking about here is 35 days to expiration, right? We want to be somewhere around that. That's the idea we're looking for. And the reason why, this is just a visual representation of what Theta Decay does. Remember, I said Theta is the thief in the night that comes and steals our premium. And yes, this is based on the at-the-money calls and the at-the-money puts. The diagram would look a little bit different with the in the monies and the out of the monies, but this is just to wrap your head around what Theta does. And, you know, we're going to be, like I said, I look at like the 90 plus days, but, you know, as that goes out in time, it flattens out. So these are the ones we're going to be buying our call, and we're going to be trying to sell a call inside of here, because we want the one we sold, collected a premium for, to really, we want that theta to really come out of it. All right. And the ones that we buy, we want to be able to hold on to that theta. That's why we want to be able to sell calls inside of this area multiple times, right? Because if we sell inside of this 35 days to expiration, well, once these kind of go out, maybe expire worthless, well, then whatever month this was, say this is the Jan, well, the Feb right here, and these are probably like the May that we're buying, right? Well, then we can roll out and we can sell the Feb. It's going to be inside of this wheelhouse again, all right? So that's what we're going to be kind of looking at there. In your Pepsi example, the debit was $13.14. The width of the spread was $17.50. So we'd make a profit of $4. Yes, exactly. Exactly. All right. Making sure that it's not a big difference in Vega between the 2 months. Now, this is really important, you guys. We want to make sure, and this is where I'm going to pull up the option montage for probably the remainder of this. And we'll go into this. We're going to go in through detail. We're going to go into this analysis throughout. We don't want to make sure, we want to make sure, sorry, I'm going to pull up this side thing. I can't do it any other way. All right. Vega, between the one we're buying and selling, I'm going to just say we're looking at just outside of 100 days to expiration, right? When I'm looking at this implied volatility over here with the Vega, then we're looking at this column right here, all right? So I don't want a big difference between this Vega and the Vega that I'm buying, all right? I'm buying way out there. Now, remember, I said volatility affects the further duration options more than the near duration, right? So what I want here is if I'm selling this one and buying this one, I don't want a big difference, because if there is a massive difference between these, say, 5 percentage points, I'm really paying up for this volatility. And if volatility comes out of this strategy, then it's going to hurt my ones that I bought more than it's going to hurt the ones that I sold. All right. So if I make them very close, then they're relatively going to offset one another. All right. So I really want to be able to have that offset in a sense. Okay. And if volatility starts expanding, then, that will help me on this strategy, believe it or not, because that volatility will affect those further durations a little bit more. All right. So let's go through a couple of examples of ones that we might want to look at. Now, I had that MasterCard example up, so let's, in the other one. So let's just take a look at it. All right. So MasterCard, let's look at the, if you go further out in time. So let's go to the June. I really kind of hover around that 90 to 150 days. Inside of that is usually the easiest, and this is one of the reasons why. So first thing we got to look at, does it fit that rule of thumb? Move it 3 ticks to the left. We've got 30 cents here, right? So do the out of the monies options closest to 35 days to expiration fit that rule? Yes, you can see MasterCard fits that rule. That's where we're looking for it. Yes, when you come further out in time, 100 plus days out, then it might be a little bit wider than that, that rule. Our rule is for the spot month, right? That gives us the indication. Because what happens is, even though these are a little bit wider, believe me, there's tighter markets in here that you guys just aren't seeing. And it has to do with spreading, all right? The way that the algorithms create spreads, all right? So there's a spread to the Feb, March, March, April, May, June, okay? So these Junes aren't really representing all of those spreads, okay, is the easiest way to explain it. They're tighter, believe me, but they just aren't being represented. Do not have a big difference between, or have a big volatile difference between the two strikes. Well, the two option expiration months is what I mean there. So between the one that I'm selling right here, we want, so my rule here is basically this. All right, here, let me drop this for a second. My rule here is, all right, if it's basically equal to or less than 2%, should have done this in green. That's a green light, okay? That means that's a green light. I'm just going to write it in this because the other pin's giving me problems here. Yes, I want to close you. All right. If it's basically, if it's 3 plus, all right? So like maybe it's 2.3 or something like that. I don't care about that. So 3 to 4%-ish, all right? That makes it like a yellow light, all right? If we get too many of those, then, too many yellow lights, then there's better strategies out there, all right? And then if it's greater than 5%, that is a red light, all right? We want to move on, all right? So that's kind of what we're looking at here for the wheelhouse. And the reason why what I'm saying with these red light, green lights, if, let's say you paid too much for the extrinsic value where you're buying this strategy and it's trading above where the underlying is currently at, well, that would kind of be a yellow light, right? You're buying it above where the underlying is trading, your break even's higher. And another one is you're using Gilead, which is all over the place, all right? That would definitely be a yellow light for me, all right? So you get too many yellow lights, then there's different strategies out there that are better. Okay, so that's what I mean, difference here. And that's going on the increase, you guys. So if it's ever lower, which I think in that example that I was showing before, let me try and find it. I'm going to have to do the slider here. Hold on. On this one, this is a great example of it. If you notice this one, the volatility is lower further out. So I'm buying lower volatility than the one I'm selling. So I'm getting paid, right? That's not what I'm talking about I'm talking about an increase in that volatility, all right? So, and usually that's what happened. Further duration options have more volatility in them, like this one. So this is less than a 2% increase. So that would be like a green light, all right? All right, so anything more than that, then we're going to be having to worry about it. So I want the implied volatility on the side here, which is the one I'm more concerned about, having less than 2%, 2 to 3%, it starts becoming a little iffy. If it's 5%, I would walk away from it. You're just paying way too much, and you're going to be way in the money. So let's just take a look at this one. I want to get back to my delta, my theta, my gamma. So let's look at the June. I talked about it. We're going to be looking at the 84-ish delta. But here's another little trader hack, and it's not always exact. It's pretty close to it. But how do we figure out what this is valued at? Well, you can say I can take $2 or $255, which is where I'm buying the underlying, and figure out what the difference is up to 303.39. Well, that difference right there is about $48.39, right? So $48.39 is $49 is about what this is worth, okay? But then we can kind of take a look at it and do a little hack over here and say, well, that's about what the extrinsic value is, all right, over here on the corresponding put. So usually the corresponding put is very close to where the extrinsic value is. Of course, it's not working out on this one, but a lot of times it will be very close, maybe 25, 30 cents off, because it's such a high flying stock, high flyer, expensive stock. It gets a little bit further out, but that's the idea. So what we're going to do is kind of buy that one and then go over here. And what did we say we need to do? About $4.80 I need to pay off. So then I would have to probably go and sell at least the $6 ones to pay off that extrinsic value, because this one's not going to, right? We know it's a little bit more than that. So in this case, what we're doing is we need to next figure out if we came up with the right amount on the price. Where's my calculator at? It's hidden. Here we go. All right, so let me get my stuff all set back up. All right, so $47.78. One of the things I said, where's our break even? $2 or $255 plus that $47.78, right? So we figure out where our break even is. Our break even is actually below where the underlying is currently trading. All right. But now we need to figure out what the percent of the width is. John David probably did this in his head already and has got it up over there. So we take 47.78 divided by what the width of the spread is there. So that's 55. We're at 86, 87%, right? That's way too much, too expensive. Despite the fact that I'm able, I'm able to buy it well below where the underlying is trading, so my break even's lower, but it's not enough reward for that risk. And the risk reward on this, is better than buying a stock and doing cover and call, but it just seems a little too expensive for my taste. So in that case, if you see something like that happen, then I would go and delete that one and look at maybe a little bit nearer duration here. So go and look at the 84 deltas. We're looking at the 270s. And how much do I need to pay off? About $3.75. So then I'm going to be able to get further out. So $3, so I'd have to sell those on the 315s, right? Now my break even is 203.58. So that's right where the underlying is trading, right? 33 plus the 270 gives me, 303.58, slightly higher, but it's kind of middle of the market. It's a little higher than the last trade, but middle of the road. Now we do our math on this. John David's doing it in his head right now. And basically we take the 33.58 and divide that by the width of the spread, which is 45, right? He beat me. So it's about 75. Oh, he was on a call. He dropped me. So that one fits the rule, right? It's less than the 75% the width of the spread. That is the one that I would go with. Another reason why I look at that 90-ish plus days, 90 to 120, 30 days, is because usually it makes it a little bit easier, all right? If you're going further out in time on that further duration, make sure you're trying to build it out to where you get to that 75% the width, which means you're probably not paying off all of the extrinsic value on this, all right? All right. So I'm going to be looking to do that one, or this is another one where I am keen on is Activision. I think that they had a banner year. I think all the kids were buying Madden, at least my kids and all his friends were. So, that's my litmus test is what my kids are doing. They're off of Fortnite and on to Madden. So I'm going to look at this. The May is the one we're looking at. I'm going to be looking at somewhere around that 84-ish delta. It's a pick 'em between these. I'm going to go with the 50s because I have a feeling I'd probably be able to find a better market on the 50s than those half ticks anyway, and considering they're a little wide out in time. They fit the rule on the less than 10 cents on the spot month, right? But a little bit out here and deeper in the money you go, they have a tendency to get a little wider. So I'm going to be looking at buying that one and then looking at my extrinsic value. How much do I got to pay off? About $1.40 something. So I'm going to have to look at the Feb 2.5. I'm going to go with the 2.5s. I'm probably 58.87, just a little bit higher than where I'm buying it a little bit higher than where the current market is, which means I'm not paying off all the extrinsic value, but I also want to give myself a little bit more room on the width of the spread. So we could check this out and do the math on it. $8.87 divided by the width of the spread, and we got $12 there and 50 cents. So 70. So that's pretty good. 71. All right. That's pretty good also. So that fits the rule. Now, one thing to note with, and I forgot to check this, make sure that that is within the realm, and that is less than that 2% difference. So that makes it a definite green light. We're good to go there. An example right now of one that is inverted is Procter & Gamble. And it's probably because they have an earnings coming up in this February. So it's right around the corner. So a lot of times that is something you're going to have to check out and be like, wait a second. Volatility is a little bit higher. Is there an earnings there? It's not always, but something to be aware of. I wouldn't necessarily want to do a covered call strategy in an earnings, like setting it up right now. If I was bullish for that event, right? If I'm bullish because of that event, there's better strategies out there than a covered call strategy or the poor man's covered call. So I would try to avoid this on an earnings trade, that short call. If I'm bullish in this long term, think about your mindset. If you're bullish for that earnings event enough to buy the stock, well, then why would you limit your upside risk? All right, you got to be worried about the downside really to have the covered call strategy and and limit your risk. All right, so which also limits your reward in this. One thing I think I didn't go over a whole lot was, remember, this one has a synthetic put in there, because if I bought this stock XYZ, right, and went out and just bought the stock and then sold the calls against it. Let's say I sold those same calls. I don't even know which ones I was looking to pick. Can't do a custom. Why can't I? Why can't I sell the calls against it? And then buy the underlying? Let me do that. I don't know why it's not right now. Probably because I have this set up. Maybe I have to go to 0 to a 1. I don't know why it's not letting me do that over here. Anyway, at any rate, what I want to say is that if I bought that stock at 123.41, right, my risk is all the way down to 0. Well, one of the things we talked about this is if I'm buying this in the money call, well, I have the right but not the obligation, right? And if this goes below $110, I don't have, it's a synthetic put. I mean, I don't risk any more than that debit I paid. So I'm basically, if I had bought this in the money call and then sold the out of the money one, right? Not that this fits all the rules, but what I want you to understand here is that if the underlying went downward, well, my risk is no more than this $12.12. Okay, so the underlying keeps going down. I don't have to worry about it. Does anybody else have any other questions? No? John David's still on a call? All right. All right. So without further ado, we've got this option trading course special where you basically get all of these for $297. Usually these are about $1,000 each. And, you know, you get more than just these 3 or 5 webinars in there. But each of these is at least an hour-long webinar. And we're talking about, in this one, all about volatility and how that affects your premiums. That will help you guys sleep at night. You will really understand buying and selling options and when you should be buying and selling option. Floor trader hacks, the right things to, how we can talk about like delta. You know, delta is the probability and affects the premium. Shortcuts, basically streamlining your process throughout all of this stuff. There's 9 floor trader hacks there also that we talk about. The basics, so if you're newer to options trading, it's a fun one where I'm basically giving you easy ways to learn the basics of options. You know, some of those simple tricks like theta is the thief. You know, none of you guys are going to forget about theta now, right? But that is great for the options basics and the option terminology. The history of options is a really good one. You know, how did options ever get started? It was actually a guy and olive presses in Italy. And then basically how to learn how to trade options like the Wolfman, setting up your option screens, all of those different things, using market profile and trading that way. All of those are included in this with 4 courses for $297. And as a matter of fact, if you are taking advantage of this right now, I'm going to throw it over there in the chat window, the hot link that you guys can click on it here in just a second once I pull this up. This is the course right here. I'm going to throw the link in the window, copy it, and paste it to the entire audience, and you're good to go. So you click on the hot link I throw over there in the chat window. Like I said, we've been going back and forth in the questions box. The chat window has this. You also get an extra Christmas special with the 50 extra recorded lessons, all right? So this is bonus with this one. Take advantage of it. If you guys enjoyed this, if you learned anything, I know I teach a little bit different, and I do that because I try and think of ways so that you guys can remember this stuff a little bit longer and easier. So take advantage of that 50 course recordings for that bonus, if you will. All right? Without further ado, I want to thank you guys all for taking advantage of this. Later webinars, I'll be drilling down on different option quotes where I find those. Here is also the link to that special. If you have any questions, comments, reach out to us, 310-598-6677, or email me at trading@protraderstrategies.com. Like I said, that's not a hot link. The hot link's over in the chat window. So take advantage of it for the $297. It's well worth it. All right. That's all I got. Other than if you can't take that, take it easy. Bye for now.